On October 17th, 2025, gold printed a high of $4,379.13 an ounce. It was the metal's most explosive stretch in decades, one fresh record after another. And if you were watching the chart that autumn, you saw something strange happen over and over. Price would push just above an obvious high, tag it, and then fall apart. Retail traders looked at that push and read strength. They bought the breakout. Smart money looked at the exact same candle and read something completely different. They weren't buying the breakout. They were waiting for it because the breakout was the point. The stops sitting above that high were the whole reason price went up there in the first place. Same chart, same wick, two opposite outcomes. One group got filled at the top and stopped out minutes later. The other group used those stops as fuel. The thing standing between them has a name, and it's the most misunderstood force in this market. It's liquidity. And today you're going to understand why gold seems to hunt your stop before it ever goes where you thought it would. Here's what we're covering, what liquidity actually is in plain English, where it pulls on a gold chart and why those spots are so predictable, what a stop hunt looks like candle by candle, what retail does when it happens versus what smart money does, and then the honest part where I tell you how often this fails and how not to blow up chasing it. Not financial advice, just education. Let's get into it. Start with the word itself because it gets thrown around like everyone agrees on it. Liquidity just means resting orders. It's the pool of buy and sell orders sitting on the book waiting to be filled. That's it. When someone says a level has liquidity, they mean there are a lot of pending orders parked there. And the single biggest source of those orders is stop losses. Every trader who went long placed a stop somewhere below. Every trader who went short placed a stop somewhere above. Those stops are just pending market orders waiting for a price to touch them. Now think about why that matters to someone moving size. A large institution isn't trading your position size. They're trying to fill orders measured in tons of gold exposure, and here's their problem. If they try to buy a huge amount all at once, they push the price up against themselves before they're even filled. They need a pool of sellers to buy from without moving the market against their own entry. So where do they find a crowd of sell orders all clustered in one place? Below a swing low where every retail long has parked a stop. Those stops, when triggered, become sell orders, a wall of them. Exactly the liquidity a big buyer needs. That's the mechanism. Retail traders see a stop loss as protection. Smart money sees your stop loss as a filling station. Your exit is their entry. Let me walk you through what this looks like in practice. Picture gold trading in a range during the quiet hours before London opens. Price has bounced off roughly the same level twice. Call it a clean floor that everyone can see. Because everyone can see it, everyone trades it the same way. Longs buy the floor and tuck their stops just underneath. Breakout sellers place their sell stops just below it too, betting on a breakdown. So now you have two crowds stacking orders in the exact same pocket of price, a few dollars under an obvious level. That pocket is a liquidity pool. It's glowing on a screen somewhere. Then it happens. In a single sharp candle, gold spikes down through the floor. It slices maybe $5, $10 below the level, triggers every stop and every sell order sitting there, and the fills cascade. For about 90 seconds, it looks like a breakdown. The retail long who bought the floor just got stopped out at the worst possible price. The breakout seller who shorted the break just got filled, feeling smart. And then the candle closes back above the level like nothing happened, and price starts grinding higher away from both of them. So watch what each side actually did. Retail did two things, both losing. The long got shaken out right before the move they were correct about. The breakout short got trapped short at the exact bottom, and now they're the fuel for the next leg up as their stops get run in turn. Smart money did one thing. They waited for the sweep. They let the level get violated, let the stops trigger, let the panic fill their buy orders cheap, and only then did they commit. Retail asks, did the level break? Professionals ask, did the level get swept and reclaimed? Those are completely different questions, and they lead to completely different trades. Why does gold do this so cleanly compared to a lot of other markets? Because gold's obvious levels are extremely obvious. The previous day's high and low, equal highs where price failed twice at the same spot, round numbers like $4,000 that every headline mentions. The more visible a level is, the more orders pile up around it, and the more orders pile up, the more worth it becomes for size to go collect them. The irony is heavy here. The cleaner and more textbook a level looks to you, the more likely it is to be the trap. A level that's obvious to you is obvious to everyone, and a pool everyone can see is a pool that gets drained. Think of it like a dam. Behind every obvious level, pressure builds as orders accumulate, all those stops stacked up like water. Price doesn't drift gently through a dam. It pushes until the wall gives, releases everything at once in a violent flush, and then the water level settles and the real current continues in whatever direction it was always going to go. The flush isn't the trend. The flush is the release. Your job is to not be standing in the spillway when it lets go. So how do you actually use this instead of getting used by it? The shift is to stop trading the level and start trading what happens at the level. When price approaches an obvious high or low, you're not asking whether it breaks. You're watching for the sweep, the fast violation that triggers the stops, and then the reclaim. Price snapping back to the correct side of the level within a candle or two. The sweep plus the reclaim is your signal, not the break itself. You wait for the liquidity to get taken and you trade the reaction because the reaction is smart money showing its hand. Now, the honest part, and this matters more than anything I've said so far, this is not a guarantee. Not every wick below a low is an engineered stop hunt. Sometimes a level breaks because it's genuinely breaking and price keeps going and the reclaim you were waiting for never comes. That is a real breakdown. And if you're short, the reclaim that never happens, you lose. So you use a stop, always. The whole point of understanding liquidity is that you know your stop can get hunted, which means you place it with intention beyond the obvious pool rather than inside it, and you accept that it can still get hit. There is no setup on earth that removes the need for a stop, and anyone telling you otherwise is selling something. A few more warnings. Don't overmark your chart. Once you learn to see liquidity, you'll start seeing it everywhere, drawing a dozen zones until the whole screen is a rainbow of levels and you've talked yourself into a trade at every one. That's not analysis, that's noise. The strongest pools are the few most obvious ones, the daily high, the daily low, the clear equal highs. If you need to squint to justify a level, it isn't one. And on choppy, directionless days when nothing is clean, the correct move is to do nothing. No sweep worth trading, no trade. Sitting on your hands through a bad session is a skill, and it's the one that keeps your account alive long enough for the good sessions to matter. Here's the shift I want you to leave with. A liquidity grab isn't a pattern on a chart. It's a decision made by someone with more capital than you, and it's aimed directly at the orders you place for perfectly reasonable reasons. The wick that stopped you out wasn't bad luck, and it wasn't the market being unfair. It was the market doing exactly what it's built to do, moving to where the orders are. Once you stop seeing candles and start seeing the decisions behind them, gold stops feeling like it's out to get you personally. It's not personal, it's just liquidity, and now you know where it lives. So tell me in the comments, what's the level that keeps hunting your stops? Is it the daily high, the daily low, or that psychological round number you keep getting wicked out of? I read these and I want to know which pool is eating you alive. If this made the chart make a little more sense, subscribe, because that's how the channel grows and it's all I ask. I'll see you in the next one. Stay disciplined.